Welcome back to The Explainer. It's August 19th, 2026, and wow, we are looking at a week where the fintech sector just had an absolute blockbuster of a Wednesday. Okay, let's dive right into this, because while this sector, it often runs on hype and momentum, yesterday was one of those days where the actual hard numbers completely backed up the market vibes.
You see, some days the market just moves on absolutely nothing but pure speculation, good old vibes. But this particular Wednesday was different. We actually saw the market move on real hard data. Across the board, we got earnings and metrics from some very different corners of the industry that either confirmed the party was real or, well, gave us some pretty serious reality checks.
So to deeply understand the earnings we're about to look at, we first have to step back and examine the macro tailwinds that were setting the stage. Basically, falling treasury yields sparked this massive broader risk rally. Lending names got a huge lift. SoFi was up 6%, Upstart jumped 8%, and Affirm climbed 7%. And at the exact same time, crypto just completely ripped, with Bitcoin clearing $68,000. Plus, over in Washington, we saw Coinbase executives meeting with former President Trump at the White House to push for regulatory clarity, while the SEC actually proposed a new regulation crypto assets framework that offers token issuers exemptions up to $75 million. Now, regardless of where you lean politically, left or right, from a purely market perspective, these regulatory talks were a massive catalyst. They sent Coinbase up double digits and Robinhood up 4.5%.
Okay, so here's our roadmap for today's explainer. Number 1, we'll look at Webull's crypto-fueled beat. 2, Jack Henry's quiet victory. And 3, Bill's expensive AI bet.
Part 1, Webull's crypto-fueled beat, a double beat.
Before we look at their blowout Wednesday, let's just do a quick refresher on who they actually are. Founded back in 2016 down in St. Petersburg, Florida, Webull really isn't just a startup anymore. I mean, they run licensed brokerages across 18 markets and serve over 28 million registered users. They are going toe-to-toe with Robinhood for the retail trading crowd. And as we just saw with that broader crypto and risk rally, that retail crowd is incredibly active right now.
Now, what's really fascinating here is the sheer scale of their financial outperformance. Webull dropped their Q2 2026 earnings right after Wednesday's closing bell. And they didn't just beat Wall Street's estimates, they completely crushed them. The street was looking for about $181.3 million in revenue and 5 cents in consensus adjusted EPS. But the reality? Webull delivered $198.8 million in revenue, which, by the way, is up 51% year over year, and an actual adjusted EPS of 12 cents. That is more than double the consensus. This absolutely obliterated expectations, and it led to an immediate 8.1% share pop in after-hours trading.
But if we really want to understand why this matters for the long-term health of the business, we have to look at one massive metric, 79%. That is their year-over-year customer asset swell, bringing their total platform assets to $28.5 billion. This is huge because it proves that retail traders aren't just, opening accounts to look at pretty charts. They are actively depositing and holding significant, real capital on the platform.
I absolutely love how the source text perfectly summarized this. They said it was the fintech equivalent of your entire fantasy lineup hitting the over on the same Sunday slate. Everybody won, but Webull won and had the receipts to prove it wasn't luck. And it's true. While those macro tailwinds certainly helped turn a good quarter into a highlight reel, Webull's earnings were undeniably strong entirely on their own standalone merits.
Moving on to part 2, Jack Henry's quiet victory, winning the arms race.
All right, let's completely shift gears here to a really grounded, reliable veteran in the space. Jack Henry & Associates is a technology provider founded way back in 1976, based out of Missouri. Basically, they supply the core banking, digital banking, and payments infrastructure that keeps thousands of community banks and credit unions running. Now, I know you're thinking, this is definitely not the kind of name that goes viral on FinTech, but they provide the absolute crucial plumbing for community institutions who are making the choice to modernize right now rather than just get acquired or fall completely behind the megabanks.
So the crucial point I want you to take away here is the number 58. That is their competitive core wins. That's their highest number of wins in over 2 decades. And get this, within that 58, they actually landed their largest ever bank client, Wood Forest National Bank. In a highly competitive enterprise software space where, let's be honest, switching out your entire banking infrastructure is incredibly painful and difficult, winning 58 new relationships in a single year is a massive statement of industry trust.
Let's walk through the financial box score that this kind of dominance generates. For fiscal year 2026, their revenue hit $2.5 billion, which is up 7%.
and they expanded their operating margin by 92 basis points to a really healthy 24%. Looking ahead to 2027, their guidance predicts non-GAAP revenue growth of 6.3 to 7.3% and EPS somewhere between $7.33 and $7.38. And the market absolutely loved this rock-solid predictability. They rewarded them with an 8.4% share jump on Tuesday night following the print. It just goes to show that in this space, boring is beautiful when it leads to record earnings.
It really is a fascinating contrast, isn't it? Going from the explosive crypto and retail names to this. As our source analysis notes, think of it like a veteran pitcher quietly stacking wins while everyone's watching the flashier rookies. Nobody's talking about Jack Henry, but the box score doesn't lie. They literally just keep consistently striking out the competition without making a fuss.
And finally, part 3, Bill's expensive AI bet, growing revenue and loss.
To give you a quick snapshot of our final company today, Bill Holdings operates a software-as-a-service platform that basically automates accounts payable and receivable. They serve roughly 500,000 small and mid-sized businesses. And to give you a real sense of their scale, they processed $98 billion in total payment volume just in Q4 alone. But what's really driving their narrative right now is that their CEO, René Lacerte, is aggressively pushing AI adoption. He views it as the absolute next critical growth lever for the company. But as we know, that kind of pivot requires some heavy investment.
And this brilliantly illustrates the exact tension going on with Bill right now. It's a classic case of the good versus the catch. On one side, you have the good. Revenue actually beat estimates at $436.2 million, up 14% year over year. Full-year revenue climbed 13% to $1.65 billion, and non-GAAP net income jumped a massive 52% to $94 million. Amazing, right? But then you have the catch. Their GAAP net loss widened from $7.1 million a year ago to $18.5 million. On top of that, their operating loss grew from $22.3 million up to $34.3 million. So they're generating great top-line revenue growth, for sure. But the massive spending required to pivot to this AI-first platform is actively widening their actual losses.
I absolutely love how the source text frames this heavily analytical data. They called it, quote, the financial equivalent of joining a gym in January. The investment shows up on the bill before the results show up on the scoreboard. That is exactly what you should take away from this. The revenue growth is undeniably real, but Wall Street investors, they are going to want to see those AI-driven losses begin to shrink before they completely buy into this turnaround story.
So, let's kind of synthesize these 3 distinct stories and look at our final Wednesday verdict. Webull cashed in on a broader market rally with a massive crypto-fueled double beat. Jack Henry just kept winning quietly, proving that critical infrastructure can generate record earnings and an unheard-of 58 core wins. And Bill Holdings? Well, they showed us that while revenue can absolutely grow, paying for future AI growth means the results aren't fully banked just yet. Now, just a quick reminder, this explainer is for information and entertainment purposes only. Definitely not investment advice. I mean, I might not hold positions in all these companies, but you can safely assume I own at least one Fintech hoodie and way too many debit cards.
Which really just leaves us with this final, kind of provocative question. Is Fintech still boring? After seeing the explosive retail crypto trading on Webull, the rock-solid infrastructure dominance of Jack Henry, and the high-stakes AI gamble at Bill all playing out on the exact same Wednesday, I think it's safe to say this sector is as dynamic and unpredictable as ever. Thanks so much for joining me for this explainer. Keep learning, and I'll see you on the next one.